Hello and very good morning to all our dear students. I hope you are doing fine. Today we are starting with a new chapter which is conducted by our very respectable Board of Studies. We are starting with the concept of international financial management. Since in the last class we have already discussed about few concepts in Forex that we will be using over here as well. Okay. Do not think that a lot many students think that we can skip the Forex chapter and we can do the rest of the chapter for the examination purposes. So for those, I would like to tell you that it's not that easy because there will be certain concepts, okay, that you will be using in this current chapter with respect to the Forex chapter. What I would like to say in this that you must have read the concept of spot rate and the forward rate. You've also read the concept of called as interest rate parity, purchase power parity, and a lot of other things as well. So those concepts we'll be using over here. Okay. Hi Teju Akash, a very good morning. Thank you for coming so on a timely basis. Okay, guys. So if you don't have any doubts from the Forex chapter, I hope I was able to cover up the entire content over there. Here also, the chapter is little wide, but to be very honest, if you have a good understanding of your CA Inter, yeah, you heard it right, CA Inter. So you will able to understand this chapter very easily. What I'm trying to say is that this is called as the international financial management. The financial management you have already done in your CA Inter classes. Okay, agreed. So you know the concept of calculation of NPV, you know the calculation of discount rates, all those things. So now the similar question will not come because you have already covered in your C Inter exam. So you are not supposed to ask how do you calculate the weighted average cost of capital or let's say discount rate or using CAPM in this. You will be given certain cash flows, but in the foreign currency. Okay. So the questions in exam comes in this way that you are either in India or you are outside India. Okay. And you want to create a subsidiary, okay, outside your home country. You are getting a point. Wherever you are located, whether in India, UK, US, wherever, you will be asked to prepare a subsidiary which is located outside India, okay, outside your country, wherever you are. And the cash flows that you will be getting will be obviously in those foreign currencies. So that becomes a little challenge that how do you would like to convert them. So using the conversion concepts, again, you need the direct quote, indirect quote wala concept, the base currency wala concept. Second, to calculate the impact of inflation on the currency, you remember? Purchase power parity, we understood the correlation between spot rate and the inflation. And the IRP was the correlation with spot rate and the interest rates. Okay, so these were all things. Let me just first show you as to what we are doing before we go to any topic. Okay, fine. So this is basically our chapter. As you can see, that a name called as international word has been added to it. Otherwise, if you really trust me, this concept you have already studied in your CA Inter. Same concept, nothing new. What you are required is you are required to calculate the NPV, and you know very well for calculation of the NPV you require two things. One is a cash outflow and one is the cash inflow. Here the cash flow could either be in Indian currency it will be given, you have to convert them, or you have to do it like this, I mean directly. Cash inflow will obviously be in the foreign currency, so you will have to discount them and the discount rate will have to be given. Okay, so before we proceed further, let me give you a glimpse as to what we will be doing on this. Just one second. So before we start anything, the very first thing that you require in this chapter is beta, the concept of NPV. Okay. So how is the question coming in the examinations? Okay, generally, again, I'm not from examination, I'm from Board of Studies. Board of Studies make sure that you get the entire content on a nice, crispy manner, understandable. Okay. So you are here, okay, let's say in India, and this is another country. Okay, so let's take USA. Simple. So you want to create a subsidiary outside India, say US. I'm sure I cannot ask this question that you don't know what's a subsidiary. Okay, 100% undertaking. Okay, shareholding. So in this case, the cash outflow by our Indian company. Okay, so this is A Limited, and let's say this is a new company. So they will have to pump in some money. So when they pump in some money, that is called as the term of cash outflow. Okay. So in the exam, this A Limited will be given to you. Obviously, that how much money are they putting, are they pumping in? So let's say they are pumping in 10 lakhs, or let's say 1 million rupees. Okay. And for example, the spot rate is 50. So the cash outflow will be, if it asks you in the INR terms, it will be 1 million. And if they ask you in dollar terms, it will be 10 lakhs divided by 50. So $20,000 will be the concept. Sir, why are you explaining these two things, rupees and dollars? Because beta, there is a concept called as the foreign currency and home currency concepts, which are very important from the examination. Students lot of time lose marks from this chapter because of the presentation. Yes, you heard it right. A lot of students lose their marks because of the problem with the presentation. So if they can work on their presentation, they can get good marks. And if comes, it comes, for 8 marks, 10 marks generally. I don't know what's the examiner's mind this time, but it's an important fact. So this is the first concept that you should be knowing, which is the cash outflow. I mean, how much money you are pumping in the starting of the venture. In terms of this company, when this company will start running its operations, okay, they will start manufacturing it or servicing it, whatever, okay. So they will also give you a revenue. So we don't say revenue in terms of NPV, we call it as cash inflow. Sir, what is the difference between revenue and cash inflow? There is a lot of difference in that, because revenue means only sales, and we don't even use the term profit. Okay, profit means what is actually earned after taxes. Okay, and if you remember from your CA inter concept, when we calculate the PAT, okay, when we calculate the PAT, we add back the depreciation or any amortization. If you remember, this is called as the cash inflow. Okay, this is called as cash inflow. So this is different from revenue. This is different from profit. How this is calculated? This is calculated in this particular. Okay, clear? Yes, sir. But there is one other problem. What, sir? Nothing new. You have already studied that. This cash inflow has to be calculated as per their present value. Means the amount that you will be getting in the next few years, you have to discount it today. I mean, what will be the amount that it has the value today? So to discount that, to make that present value, you need a discount rate. Okay. So in the exam, I have seen, as per my experience, the examiner has either given you a discount rate or you have to calculate it. Both the things may be required in the exam. So when it calls for a discount rate, beta, I hope you remember how we calculate a discount rate. It is calculated with the help of WACC, the weighted average cost of capital. You may be required to use this WACC not only in this chapter, but going forward chapters as well, which is generally corporate valuation and the mergers and acquisition. There you'll be required to use this in a very, very comprehensive manner. Okay, I may not be taking the merger acquisition, but at least you should be knowing that WACC is quite important. And to be honest, it is nothing new. The concept that you studied in your CA Inter, it's exactly the same. Okay, beta, clear? Yes. So this concept is clear. Till now, for the last 5 minutes, I have taught you what you must have studied in your CA Inter. Now I'm coming to the concept what you will be using in this chapter from the previous chapter. Which one chapter, sir? Beta Forex chapter. Yes, sir. So one concept you have already used. Yes, sir. What concept have you used for Forex? Sir, we have converted this INR with the help of spot rate to calculate the cash outflow. You are absolutely correct. So one concept you have used. Whether I have to divide it or whether I have to multiply it, this you already know. Okay, the base currency wala concept. The next important thing that you require is the concept of the relationship between interest rates and the inflation rates. Okay, sir, what are these? See, beta, I told you in the Forex chapter. Let me give you a recapitulation again. Even if you have forgotten, not a problem, since you have time in your exams. When you make a correlation between the spot rate and the interest rate, that talks about the concept of interest rate parity. Why I am spending time in this concept is because you will be using this in your main question, and that will be very, I would say, comprehensively used. I mean, comprehensive use means without calculation, you cannot move to the main question. You will get stuck over there. How? I will tell you in next few minutes. Okay? And when there is a relationship between inflation rate and the spot rate, okay, so that concept is called as the purchase power parity. Okay, so as I told you in the Forex chapter also, international Fisher effect doesn't have much practical application in our course, luckily. So it talks about both the things. Okay, when you talk about both the things, it talks about the international Fisher effect. This I've already taught you, I think maybe in the third Forex class, maybe. Okay, maybe second or third. So if this concept is you are remembering, you will get to know how do you calculate the discount rate with this perspective. Okay, the discount rate might not be given it to you, so you will have to apply that in the exam. Otherwise, you will not get the full marks. Okay, so with the help of this, please, a lot of students get confused between interest rate and inflation rate, but both are absolutely different. They have no correlation. Just to again recapitulate for another 1 minute, if the interest rate of a country, you remember, if the interest rate of a country are lower, their currency gets stronger. Where the interest rates in a country is lower than the another country, okay, ऐसा नहीं कि बिल्कुल ही कम हो, with respect to another country. If India has the interest rate 6%, okay, and US has, let's say, interest rate of, let's say, 2%. So they have interest rate lower than India. So they will have a stronger currency than India. And we know that the proof we already know. Okay. So this is the concept over here. Till now, this is what we have read. Okay. Nothing new. And we will start with the concept of NPV going forward. Okay. Any doubts you can ask me. Otherwise, I'll just rub the board and I'll show you what we are supposed to cover as far as this chapter is concerned. Okay, so beta, this is the three concepts that you will be studying. Okay, honestly, it might not be very easy for you, but again, at the same time, it will not be tough for you. Okay, if you read it regularly, you will understand. The first one is the international capital budgeting, which I'll be covering in a very comprehensive and a detailed manner. Almost today's class will be devoted to this, or maybe next as well, to some extent. Then comes the international sources of finance. This is important, again, from practical as well as the theoretical, both of these. So you will be getting the understanding of FCCBs, American deposit receipt, global deposit receipts, and other syndicated loans, etc. The theory for that I've already shared this slide on the website, so you will able to, you will able to get the download facility. You can keep it and preserve it for your examination. That will be quite helpful. Even if you don't like to use that, I have prepared all these material from our very nicely prepared study material, so you can have your self study from the study material. Then you can use these notes later on, okay, as a revision purpose. And then comes the international working capital management. Again, this is something which you have already done in your CA Inter, but again, the word of international was not there. Working capital management, you've done the concept of EOQ, okay, the debtors management, creditors management, all those things you've already done. So that will not be done. Majorly, we'll be discussing about this. Okay, guys. So without wasting any time, if you don't have any questions, I can't find any questions. Let's start with this chapter. Okay. So what we will be studying as of now, this is what called as the concept of home currency and foreign currency. Okay. So there are two approaches. Let me just start doing that. Okay, beta. So basically, calculation of NPV in your exams have two approaches. Okay, just be attentive. Huh? This is quite important, which I'm talking about. Okay, two approaches means one is called as the home currency approach. And one is called as the foreign currency approach. Home currency approach, what does it mean? Okay, sir, will the examiner ask us on the face that we have to calculate? Yes, absolutely. Sir, if you don't follow that, beta, you will lose marks for sure. Because the concept in both the cases are same. Because the NPV, I'm writing the conclusion. Okay, I'm writing before I teaching, I'm writing the conclusion. Conclusion that NPV in both the cases will be same. NPV will be same in both the cases, But what all matters is the presentation. Okay, I'll show you how the presentation is done. Okay, and I will prove you this as well. Okay, so beta, in home currency approach, what does it mean? Please, you can write it if you have a notebook with you, or if you're just being a spectator, just see that. Basically means, what does home currency approach means? Okay, simple thing. Means that we bring the cash flow in our country. Okay, we bring the cash flow in our country. Okay, in our country. Okay, so it means if what we are earning outside. Okay, sir, can you give an example bit of what simple is? You must have eaten once in your lifetime McDonald's burger. Okay, Burger King. I mean, these are all brands which are once was incorporated outside India. Now they are in India. Okay, best example is McDonald's. So McDonald's, the time it came in India, far more years before it was in US. They decided why not to change the taste buds of the Indians. People those times when McDonald's was not there was eating majorly roadside food. Okay, even if it was healthy or not, they used to eat roadside food. I mean, all those burgers, patties, and all those things. Quite cheap and nice. The standard of living of the people were little not as good earlier. Okay, you had a very single earner in your family, then you have your entire family. These days you can see that most of the household both are working. I mean, wife is concept is less. You find the wife also working, husband also working, and the task of the wife of like cooking and all is being carried out by the household helps. Okay, I mean, you have your maids and all those things, or you, even if you don't have, you order it from outside with the help of Swiggy and all. So now, since the income has increased, we have job opportunities. They thought, why not to bring the concept of McDonald's in India so that people can come to their restaurant and eat in a very hygienic manner. Okay, hygienic manner, and they develop our taste buds of the burgers with aloo tikki, with cheese, with Pepsi, with iced tea, a lot of new things came. So they started making money. And whatever profit that they were making from India, they were repatriating. Repatriating means they were taking it outside India to their country. So indirectly, we would say we were contributing to the economy of the US. Okay, a lot of times. Okay, so there are a lot of things which are actually not in prepared in India, manufactured in India. It is prepared in other countries, and we are boosting their economy with our consumption. Okay, so this is what is called as that home currency approach. Means we bring the cash flow of our country. Okay, okay, of our country means how can we do that? If a country, let's say McDonald's in US, is making a subsidy in India, so what the McDonald's in India earning? They are earning in INR. Obviously, we don't go to the McDonald's say take the dollar. Since you are from USA, take dollar. We give them INR. So they earn in INR, and when they want to repatriate, means they want to take that cash inflow to their country. What they do is they convert that amount into their home currency. Okay, by converting the amount in their home currency. Okay, that is why it is called as the home currency approach. Okay, and once they, oh, what happened? So anyhow, so once they do that, okay, and they discount with their required rate, okay, and discount with required rate of return. Clear, guys? So this is the concept. Sir, we do not understand it properly. But this is just a theory. I will come to the practical part in another few minutes. Then you will understand for sure. Okay. Then comes the concept of foreign currency approach. Sir, is it easy than the above one? Beta, both of them are easy. Both of them are easy. It's just the concept of presentation is what you need to do it in the exam to get good marks. And it really comes for a good amount of numbers. So you have a good scope that you can come to your journey very soon. That target of your 50, 60, 70, 80, whatever your target is, you can get it easily. Okay. So here in foreign currency approach, we are not converting them. Okay. We calculate the cash flows. Okay. Calculation of cash flow of that denomination. Okay. That denomination, no conversion. No conversion. Okay. So this is the conclusion. The NPV will be same in both the cases. Okay. If you have a problem with my handwriting, so I will just repeat it with you. So in home currency approach, beta, we bring the cash flows in our country by converting the amount in their home currency and discount with the required rate of return. And in the foreign currency approach, calculation of the cash flows of that denomination only. We are not making any conversions. And the conclusion is this, that the NPV, whatever approach you will follow, the NPV gonna be exactly the same over. Okay. So should we understand this with the help of an example? Sure, sir. Okay. Sure. So let me just clear all this and start doing the example. Okay. So beta, first we are doing the home currency. Okay. Okay. So let's take an example. This is India. Okay. This is a company in India, and this is USA, and there's a company in USA. Okay. India wants to invest in USA. Yeah, the opposite thing. Okay. India wants to invest in USA in a project that is worth, say, $50,000. Okay. Currently, the spot rate is, let's take an example, 70. Means $1 is equals to INR 70. Okay, clear? And once they start investing in that, this is at T0, they will start getting the cash flows. Year 1, they will get 25,000. Year 2, they will get 20,000. Year 3, they will get 15,000. Okay. This is reducing because more competition will come across, and you might get lower money. Okay, beta, is it clear? So this is what the cash flows are. I hope this is clear. Now I'm giving you the inflation rates. Okay, why I'm stressing on the words inflation is because of the fact that inflation has a lot of difference than interest rates. Both will be given to you in the exam, so do not get confused with that. India, it is 8%, and USA, it is 15%. Sir, are these interest rates? No, beta, these are not interest rates. These are inflation rates, महंगाई, DNS. Okay, with what speed the inflation will increase. Okay, in India, the rate is 8%, and let's imagine it's 15%. Okay, so 15% means today, if you are getting onion, also let's say tomato at 100 rupees, in 1 year's time, you will get it 108 rupees. You are getting my point. If today's you are getting 1 kg tomato at rupees 100, just an example. So after 1 year, you will get those tomatoes at 108 rupees. That is what the concept. And in USA, if you are getting, let's say, onion for rupees 100, so you will get it 115 rupees after 1 year. This is what is, okay? Do not get confused. And you are also given say interest rate discounted also, okay? Because we are not using that discount rate. Okay, these are all examples. So we have just taken example that India, okay, you are in India, you want to invest in US, the project cost will be $50,000. We have to invest today at T0, at year 0, and you will be getting the cash inflows with in the year 1 to 3, that is 25, 20, and 50. Okay, so sir, this is very simple. Yes, beta, it's very, very simple. There's nothing much to be difficult in this. The only thing that you want to know is that how does the presentation take place. Okay, the presentations define your marks. Okay, okay, so shall we do that? Yes, sir. First of all, you need to calculate the exchange rate, okay, between the two. Very good question. Very good question. Very good question. Very good question. So before I proceed further, again, a very good question from a very intelligent student. So Teju Akash is asking, sir, so is inflation good or bad, sir? Definitely, beta, it's very bad. Okay. If the inflation increases, your level of consumption reduces. Okay. You're getting a point. So let's take an example, very practical example. Your mother asked you to get 1 kg tomatoes, okay, and she's presuming that it is rupees 100. She gives you only 100 rupees note. Okay, imagine you don't have any other payment criteria. You went to the vegetable seller and you said, I need 1 kg tomato, take this 100 rupees. So he said, no, beta, it doesn't worth 100 rupees, it worth 108 rupees. So what you will do? You can't go back. You said, okay, you do one thing. You give me tomatoes worth rupees 100. So you will not be getting 1 kg tomato, you will be getting little reduced, less than 1 kg. So that talks about when the inflation increases. Okay, when the inflation increases, you get a pressure on your consumption and your saving as well. Okay, and now that was a very simple thing. Now let's talk about something that you have already studied, Teju, in your bond valuation chapter. Okay, now I come to the CA final course. So if the inflation increases, the yield rises. The yield rises, so the bond selling is starts to take place. Nobody purchases the bonds. If nobody purchases the bonds, the companies who are asking for the money, they don't get the money. Okay, and they are not able to manufacture that. You are getting the cascading effect. Let's say I, as Reliance Industries, want some money. Okay, so I issue the bonds at the rate of, let's say, 6%. Inflation is high. People are anticipating that my 6%, what I am offering to the people, are not able to substantiate with the inflation. So they ask for the higher rate of return. They would start selling my bonds. If they start selling my bonds, our overall yields will start to increase, because the value of the bonds are decreasing, and I will not able to fetch good money. I'll have to shred. I have to give you 6.5 rate of interest to match up with that. Okay, to match up your inflation. So definitely it's bad. So I hope you have able to link yourself not only with the concept of inflation, but you've also coordinated yourself with the help of the bond valuation chapter as well. Okay, you must have done it in your security valuation, the third part. First is equity preference and followed by the bond valuation. Okay, I hope that's clear now. Exchange rate calculation is required. Okay, since inflation is given, beta, you will be using the concept of purchase power parity. Okay, so I hope you remember the formula. Okay, don't worry. You had forward rate is equals to spot rate into 1 plus inflation. Sir, it was interest rate, but the interest rate was in IRP. Okay, it is inflation in purchase power. Sir, formula remains the same, absolutely the same. Only this inflation gets changed. Okay, sir. So that logic, which come in the numerator, which comes in denominator, remains same as per IRP. Yes. Okay. 1 plus inflation rate. 1 plus inflation. Now, what we are doing it, beta, for what we are doing it for 70. So 70 is rupees. So you will have the inflation rate of India here and USA here. Sir, we did not understand. Beta, come back to Forex. Yes, sir. What did I teach you? What did I teach you? I taught you that once you have this rate, if this is, you remember, FR by SR is equals to 1 plus interest rate upon 1 plus interest rate. Okay, so if it is rupees, the rupees will come over. If it is dollar, then dollar will come over. It depends what is given to you in the exam. So if both the rates are given, you take any and the answer will be same. Okay, clear? Yes. Coming back to the question. Okay, 70 it is done into 1.08 upon 1.15. Okay, so where is my calculator? So 70 into 1.08 divided by 1.15. So you will be getting, first year, the forward rate will be 65.74. Since the inflation is high in US, okay, so your currency will start to depreciate. From 70, it will come to 65.74 and so on. Okay, so this is for year 1, 65.74. Year 2, like, let me write it over here, so that I can save some space, right? So year 1, it will be 65.74. So 65.74 again multiply by same 1.08 divided by 1.15. Okay, that will come out to be 61.70. How did I calculate? I put in now this rate over here, 65.74 into 1.08 divided by 1.15. This will come out to be 61.73. Now I will put 61.73 here into 1.08 divided by 1.15. Okay, so it will come out to be 57.979. So let's write that 57.98. Let's take this rate. Okay, 979. Okay, beta. Is it clear? Okay. So if these rates are okay, let's start calculating what will be your cash inflows. Sir, means better these inflows are in dollars. Okay, sir. Yeah. These are all in dollars. Okay. So we are calculating as per home currency approach. Okay. And we need to convert foreign currency into the home currency. Okay, is it clear? Done? So I hope you will start remembering these rates, everything. I think I will be requiring the page for that. Okay, let me do it over here at least still, because I don't know, eraser is not working today. Just one second. Should I stop share? Just one second. Huh? Eraser was not working. Let me try. Yeah, now it's working. Thank God. Okay. Yeah. Okay. So I am rubbing this. I thought I'll have to rub the entire question otherwise. Okay. So now what we can do is we can see what is our cash inflows in INR. Sir, why are you calculating in INR? Because this is the home currency approach. Home currency means our home currency is what? INR? Yes, sir. So we'll convert in INR. Simple. Okay, sir. Okay. So now you will calculate the cash inflows. Okay. $65.7 for this rate. Okay. 20,000 into 61.73 and 15,000 57.98. Okay, so shall we calculate all these values, Peter? Okay, this one is ready, so I will calculate this first. It comes out to be 869,695. Let me tell you again, just in case who joined us late, we are calculating the NPV using two approaches: foreign currency approach and home currency approach. Both the cases, the presentation is different, but the answer is same. You can be asked in the exam either of them. If you don't believe me, you can open up your study material. In the starting first question itself, they're asking you to calculate in the foreign currency. Okay, so this is what I am stressing upon so that you don't lose marks. 12,34,600. These are all in INRs. Okay, and these were all in dollars. So with the help of the inflation rates using purchase power parity, we have already calculated. Okay, 25,000 into 65.74. 16,435. Okay, so understandable. So it becomes easy to calculate. Now the NPV also, the cash outflow also, I can write in INR. $35 lakhs. Okay, so can we calculate the NPV? Okay, chalo. Excited? One six three. 16435. Okay. Discount rate, you remember, it is already given to us So can we do the calculations and preserve that NPV with you, because we will be calculating that same NPV with the help of home currency as well. Yes, the answer would differ about few rupees, 100, 200, 500 rupees, but it will be the same. Okay. So can we calculate that? 1.10. Let me do it in the memory form. Okay, that you can do that, or if you want, I can write full, since you should able to match yourself in the exam. Okay, so this is 1494090. Okay, or 91, whatever. 1 2 3 4 600 divided by 1.1 divided by 1.1. 1020331. 869645 divided by 1.1 divided by 1.1. Okay, so this comes out to be 653,377 minus 35. Okay, chalo, 1020331 plus 1494091. Oh, we are getting a negative NPV. Yes, I knew that, because it is not substantiating with that. This becomes 45 and this becomes 60. 60,000 only we are getting for 50,000, and with the currencies which is depreciating. So I knew the NPV would be negative. But anyhow, this is just an example. So you minus 3167 800, right? Almost minus 35 lakh. So you are getting a negative NPV of 332,200. 332,200. I hope everybody have got this point. Okay, we'll get 1 or 200 difference, not much, because again it's a calculation. Okay, so obviously you would say, sir, we will reject this NPV since it is negative. Obviously, this you are doing in CA intern. This examiner knows that you know that when to reject, when to accept. That he knows. The main important thing lies is better presentation. You might not able to digest in the very first thing, but if you don't see it again at least twice or thrice and do it yourself, then only you will able to understand. Okay, so what we have done it, let me just give you the steps once again. First, we calculated the exchange rate using PPP. Okay, and I have written over there, this is this one. These were your exchange rates. Step number 1, using PPP. Second was the calculation of cash inflows and obviously the cash outflows, 2A and 2B. Looks like a house number, huh? 2A, 2B. So step number 2A and 2B. And the step number 3, which is the calculation of the NPV, and you are rejecting that because it is negative. This is called as the concept of home currency. Thank you, Sairam. So nice of you. So again, he's getting 332,860. That's okay, absolutely fine, because some rounding of difference would be there. Okay, or you must have done that memory mein dal ke na, then, but I have shown this calculation separately, so that's okay, absolutely. Okay, thank you, Sairam. So let's calculate now with the help of the foreign currency approach. Okay, I hope this is clear. Step number 1, 2, 3 is clear. I hope no doubts. Okay, na? So we'll take the same criteria, beta, and we'll do the foreign currency approach. But again, that will be very, very simple. Okay, I'll come to that. Let me erase this. I can use the same data, honestly. Okay, I can use the same data. Okay, inflation rates are same, and cash inflow, outflow. Now, this is not required. Okay, step number 1 is not required now. Okay, this will also be not required. The blue color content. And again, the conversion of that cash flows into INR, again, that is also not required. So 2A, 2B will not be required. Yeah, NPV will be required, but in a different manner. Okay. Okay beta, chalo. So now let's talk about the first step over here. Okay, this discount rate. What does discount rate mean? What have you studied in C Inter? So discount rate means the required rate of return. हमें कितना return चाहिए? How much do we require? You are getting my point. Discount rate is nothing but the required rate of return. Required rate of return means risk-free rate plus risk premium. I hope you are getting better. This you have done it in your CAPM. Okay. How much do we have? I mean, if I'm saying you that invest in my project, the first thing as a student you will ask me, CA finance student, you ask me, sir, what is the return you will give me? If I put in bank FD, I get 6%. So I said, I will give you 7%. He said, no. Your project seems to be quite, risky. You are giving me only 1% as premium. At least give me 4%, 5%. Okay. So he said, okay, 6% was the bank is giving. I give you 4 extra. I'll give you 10%. So then he said, yeah, that is called as the concept of risk premium. Don't worry, we'll be using this in exam question as well today itself. Okay, don't worry. Clear? Yes. So this required rate of return is in rupee terms. Sir, how do you know? Because that is what we are saying. Okay. Will the rate of return in INR be same for US dollars? Sir, sorry, repeat. Yeah. Listen carefully. Will the required rate of return in India will be same for the required rate of return in the US? Sir, obviously not, sir. What are you talking? Sir, today inflation rate in India is 8%. In the US, it is 15%. So how can we have the same rate of return? It has to match with the inflation, sir. Getting my point? It should have incorporated inflation in their required rate. Sir, we are getting the clarity that we have to incorporate the inflation factor in the required rate of. But how will we do it, sir? Beta simple. Kaise? You will say, iske andar step number 1, you will say the required rate of return for what? For dollars will be, if 1.10 means 10% is for India. Okay. So we will, if take base as Indian inflation rate, how do you do it for USA? You're getting my point? I've not applied any PPP or IRP over here. I've applied simple, what do you call it? Unitary method. 6th class में पढ़ते हैं, छठी कक्षा में पढ़ते हैं. Simple unitary method. If 1.10, I need 10% rate of return is with respect to 8% inflation, we are putting the money in the US. The inflation in the USA is 15%. So you will get this as accordingly. So 1.1 into 1.15 divided by 1.08. So 1.17, 1 to 9, let's take it 1 3. Means the rate of return for dollars will become 17.13%. Sir, ye kya kiya? What have you done? Beta dekho, 10% ko we wrote 1.1, 8% ko we had written 1.08, 1.15. So 1.1715 means the rate of return will be 17.13%. So even if you do it like this, 10 by 8 into 15, you will get the same answer. Okay, clear? So this is how the interest rate will be calculated. Okay, I mean not the interest rate, the required rate of return for the job. Is it clear, beta? Yes, sir. So this is the first step and the only complicated step. Oh, wow, sir. Yeah. After this, there is no more complication. Sir, how? I'll show you. You can calculate now directly the NPV. Okay, sir, how? You will just incorporate, because this is in dollars, this is also for the dollar terms. So you will be discounting with this. Okay, yes, sir. So 25,000 divided by 1.1713 first year plus 20,000 divided by 1.1713 का square. Okay, plus 15,000 1.1713 का cube. Got it? And minus 50,000. This is also in dollars. This is also in dollars. This is also in dollars. This is also calculated for dollars, and this is also in dollars. Sir, ये तो easy है. हाँ, this is easy. Only two step required. Yes, you will get the same NPV. Only 100 to 100 rupees difference. You can check. I will be calculating. Don't worry, ऐसा नहीं. I will be calculating because I might have done some mistake. So let's calculate that. Okay. So I will take the memory, benefit from here. So 25,000 divided by 1.1713, okay, equals to memory. 20,000 divided by 1.1713 divided by 1.1713, memory. 15,000 divided by 1.1713 divided by 1.1713 divided by 1.1713. Okay, so I am getting as 45,256.07 minus 50,000. Sir, this is negative NPV. Yeah, earlier also was a negative NPV, if you remember. Yes, sir. So this will be reduced by 50,000. Okay. But sir, this is not coming as equal. Array, wait. 4743.92. Okay. Convert this into INR for the comparison purpose. NPV in INR. What is the rate, beta? 70 multiplied by 7. See, you are getting almost the same. 4743.92 into 70. You will get rupees 332,075. It was 332,200 over there. It is 332,075. So very, very simple. Clear, beta? Maza aaya? Understood? Any doubts? Let me know. Otherwise, we can start solving the assignment now. I hope you have the assignment with you. Assignment hai na? So can I rub this? I hope you must have written this. I'm sharing the assignment with you now. Okay. So this is what the assignment is all about. So although in the first question, we are not doing the first question as of now, to be honest, but still, if you see where the very first question, you can see, we'll come to this after some time. You can see it is saying the foreign currency approach. So let's do one thing. Let's calculate first the question number 1, and then we will do question number 6 because you have the matching of the NPVs over there. Okay. So let's start with a very simple one, and so that we are able to do that. Okay, clear? Sure. So beta, this is your study material question. So ABC Limited is considering a project in the US which will involve an initial investment of 110, okay, I think 11 billions. Okay. The project will have 5 years of life. Current spot rate is 48 per US dollar. The risk-free rate in US, okay, US is 8% and in India it is 12%. But now the interest rates are given. Okay, not the inflation. I gave you inflation, so we used purchase power parity. Okay, getting my point? Sir, here are we supposed to use the interest rate parity? No. Sir, why? Because interest rate parity, remember carefully. I'm clarifying your fundas. Interest rate parity in exam will be required either to calculate the forward rate or spot rate. I mean, forward rate will be given, you can calculate spot rate from there, or interest rate of either of the countries, either the home currency or either the foreign currency. So that is how it will be given to you. Clear? So here, that is not required because forward rate we don't need. Spot rate is given to us. The interest rate in both the countries are given. So, sir, what we will be calculating? I will come to that. Don't worry. Okay. Don't do any calculation which is not required in the exam. Why to, waste your very precious time. Okay. And put in efforts for which you don't get your marks. Cash inflows from the project is as follows: 20 lakhs, 25 lakhs, 30 lakhs, 40 lakhs, 50 lakhs. Wow. So calculate the NPV using a foreign currency approach. Okay. So what does foreign currency approach means? What is the first step that we did? Open up your books where you had written. We had calculated the discount rate for dollars. 17.13. You remember? That 10% discount rate was INR. This discount rate was calculated for dollars, and similarly will be required for dollars as well. So this required rate of return on this project is given as 14%. So this is assumed that this is for INR. Okay? You can use it other way also, but more appropriate assumption will be that this is for INR. You have to calculate it for US dollars. Is it okay? Yes. Okay, little different approach in this. So, foreign currency approach where we have to do only 2 steps. Number one, we need to have the discount rate for the foreign currency, means which is dollar in this case, and we also require the what you call as the calculation of NPV without making any conversions. Without making any conversions. Clear? So shall we start solving it? Okay. Now, a few minutes back, I gave you a formula. Again, it's not a formula. We have only 3-4 formulas in the entire SFM. You don't have much formulas. So I gave you a conceptual understanding that whatever required rate you need, it comprises of 2 things. Number one, the risk rate and the risk premium for that project. Okay. So this is what we will be doing right now. Okay. So should I start using the whiteboard for this question? Okay. So the first thing that you require, calculation of required rate of return for dollars. Okay. Required return for INR is equals to 10%. Okay. Is it 10? Let me just check. Oh, sorry, 14%. Sorry. It is assumed that this is for INR. So we need required rate of return for the US. So required rate of return comprise of two things. Number one is the risk-free rate, okay, plus the risk premium, okay. A risk-free rate plus the risk premium. Sir, how do we calculate that? Yeah, we write this as 1 plus ROR is equals to 1 plus RF and plus, oh, sorry, not plus, sir, multiply. Come here. Yeah, okay. Into the 1 plus risk premium. Okay, okay, sir. So what is the required rate of return in INR? Sir, it is 14%. Yes, 1.14. Okay. RF, it is given. For India, it is 12%. You have the assignment with you. So I'll show you. The risk-free rate in India is 12%. Okay. Risk premium, we can calculate that what is the risk premium we are getting from the Indian rate. It is simple. 14 is the required rate of return. 12% is what we are having as a risk-free rate. So we can calculate the risk premium from this. Sir, is it 2%? No, it's not 2%. It's the calculation is little different. Okay? You can't say directly, sir, we are getting 12% there, so 14 is what he required, so 2% that. No, not that. Okay, we'll calculate. Okay. So let's calculate that. Where is that? So 1.14 is equals to 1 plus 1.12 into a risk premium. This is, we are calculating the risk premium for the INR so that it can be incorporated for US dollar. You are getting my point. This we are calculating it for INR. Okay. From INR, we are calculating the risk premium so that we can incorporate in your dollars. Okay. So how much we will get? RP. Simple. 1.14 divided by 1.1. Okay. 178. Okay. Or you can say 0.0178% or 1.786%. Clear? No doubts? Again, I tell you, what we are doing is the required rate of return for India is given to you. We have to compute it for dollars. So we have first calculated the RP, and this we will be incorporating in simply your US dollars in risk-free rate. Is it clear? Hi Naveen, I hope you are doing good. What you are saying, sir? Why not R the required rate of return? That is what we have done. See, we have to calculate the risk premium. Okay. If you remember one thing, you remember CAPM, Naveen? I hope you remember CAPM. Sir, is it required here? No, it's not required. It's not required. It's not required. I'm just telling you what was CAPM. Okay. A lot of students might think that it should be plus. Okay. I'll tell you why this is not. Okay. Let me just tell you. 2 minutes, huh? CAPM, you remember? Yes, sir. What was that, sir? Very simple. RF plus beta, RA minus RF. Okay. What was this, sir? This is risky. You remember this? So you are adding RF plus RP. RP you're calculating with the help of beta, RM, and RF. Here, when you're calculating the risk premium, it is for a particular project. Okay, when you're calculating for a particular project, you are using the formula. You can't use the CAPM when you're calculating risk premium for a project, beta. So you use this formula in the exam, that 1 plus risk adjusted rate. Now it is called as the risk adjusted rate is equals to 1 plus RF. Okay, multiply by 1 plus RP for that project. Multiply. Okay, by mistake I wrote plus, so that might confused you. Might. I hope that's clear, Naveen. Please do let me know, otherwise I'll explain you again. Okay, clear? Okay. Now we will be calculating the risk adjusted rate for the US dollars. Okay, because we are getting the inflows in the US dollars. Clear? Okay. Okay, so this is clear. So how much we will get? 1 plus 8%, okay, into 1 plus 0.786%. Clear? So this will be 1.08 multiplied by 1.0786. That will come out to be 1.08 into 1.0786. 17 1.08 into 1.01786. Okay, so that comes out to be 1.0992. Okay, or you can say 9.93%. If you calculate for 9.9, your answer will differ from the study material, but again you will get the credit of the marks. Okay, study has done it with this, so you can calculate this 9.9. So after this, there is no problem with the question. So again I tell you that what we had done in our foreign currency approach, when I was explaining you with the help of an example, that we first calculate the discount rate, okay, for this for the US dollars, and then we use those discount rate for this one. Okay, clear, beta? Any doubts? So let me know. I can wait for you. Okay, if there is any doubts in this question. Okay. Just 1.1. Okay, beta, clear? Yes, sir. Sir, what if we don't do this entire calculation? Just like the way you have done it in your example, can we do that in exam? Absolutely correct. You can do that. So then why did you do this? Beta, just because we have to respect our study material. This is how in the study material it is given. So even if you don't want, you can do it directly the way we had done it in our exam. Okay, what have we done? I hope you have noted it down. Okay, what have we done? The required return for, I know everybody would like this one. Everybody, I'm sure, 14%. Okay, the risk free in India is, I think, 12%. The RF in USA is 8%. So how did I do it in my example that I gave you before I did this question? So the required return for US dollars will be 1.14 divided by 1.12. Unitary method. You remember unitary method I told you? Okay. So 1.14 divided by 1.12 into 1.08. You're getting the same answer. 1.09928 or 9.928 percentage, or even if you want to do it at 9.93 percentage, then also you will get the full credit of the mark. Now, which one do you like? हाँ, हर्षद का मैंने अभी पढ़ा. I'm sorry. That is what. बेटा दोनों I have to do it both of them ना. We have to respect our study material. You can do it directly as per interpolation, or you want to say you should not say this interpolation. Okay, that's okay. I mean a simple unitary method you can apply. You can do that in exam. Okay, Harshit. Sorry, I just saw your question. I think you were running far from my mind. So great. So Naveen, okay, sir. But in bond valuation, remember RF, RP, and not. That's why I was confused. Nothing to worry, Naveen Prakashji. Now I'm sure you will not be any more confused. Okay, you can use this directly in the exam, and no deduction of the marks will be. Okay, clear? Now is it fine? I hope now everybody will be smiling. Yeah, sir, this is quite easy. Okay, chalo. So shall we complete this? You will remember 9.93. So you just have to simply calculate over here. Let me do it here. Why should we rub this? Okay, so calculation of NPV, the same way I did in the exam. Did in the example number 2. One was home currency approach, now this is a foreign approach. So calculation of the NPV. Okay, so what were those numbers? Very big numbers, right? So 20, 25, 30, 20, 40, and 50. Let's do it in millions, huh? It will save time. And then we have, I think, 11 millions, right? Yeah, this is 11 millions. So let's do it 20, 25, 30, 40, 50. Okay. So 20 divided by 1.0993 plus 25, 1.0993 ka square plus 30. Oh, acha, this is in millions, right? Huh. So it will be, I think, 2.5. Okay, no doubts. Minus cash outflow, which was 11 millions. Okay, 110 lakhs of 11 millions, and you will get your answer. Clear? So I hope you will able to do that. Simple, straightforward. Okay. Yeah, Teju is also saying the same. We can do unity method. Yes, you can do this in exam. Okay. Allowed in exams. Okay, beta, done. Let's give you a minute to solve this. Not a big problem for me. Okay, students. So before now we proceed further to any other question, let me tell you one very good thing that there was a question in the exam where you were required to calculate the NPV and both should match in both the countries. Sir, was it India and US dollar something? No, it was little tough. Okay, sir. So can we do that? Yes, sir. So we will start with the assignment question, not question number 2, but question number 6. Okay, so please open up question number 6. Yes, this one. Okay, can you see? Why I am taking question number 6 after question number 1 is because of the fact that it will give you the concept of, see, I gave you an example where you have to calculate the home currency approach and the foreign currency approach. Here, we have already studied the foreign currency approach with the example. And in both the cases, I told you that the NPV would be same. Okay. This is like an interpretation. Question number 6 is like that interpretation only. Once we will do question number 6, then we will be in a position to carry out some more comprehensive questions. I mean, bigger questions which are required for the exam. Okay, clear? So it's a very small, simple question, not very tough. So let's solve this. Butler Company, a UK company, okay, is considering a new project in Australia. So now you are no more associated with India as per this question is concerned. You are basically in UK and you want to invest into a country which is Australia. Okay, the project will require an immediate capital expenditure of Australian dollars 10 lakhs plus 5 lakh for the working capital, which will be recovered at the end of 4 years life. Kuch yaad aaya? Do you remember anything? Yes, sir. What do you remember? Sir, the release of the working capital we used to do in CA Inter. Yes, that's the one. Okay. The net cash flows expected to be generated from the project are 13 lakhs before tax, and straight line depreciation over the project is an allowable expense against company's tax in Australia, which is charged at the rate of 50% payable at the end of the year without delay. Sir, this we are not very clear with this. Abhi tak to we are clear that cash outflow is simple, sir, 15 lakhs. 10 and 5 will be released. Sir, this is clear. Sir, cash inflow is also clear. 13 lakhs. Sir, is it every year? Yes. Every year. 4 years. Sir. Oh, fine, sir. Okay. This we are assuming. Yes, sir. Achha, what about the depreciation concept? I will explain you. The project will have a zero scrap value. Okay, sir. The Butler company will not pay any tax, will not pay any UK tax on the project, which is there because due to the double taxation avoidance agreement. Okay, clear? No dual tax. So the current spot rate is £1 is equals to 2 Australian dollars. Okay, £1 is equals to, because it says Australian dollars per UK pound is 2, and they are expected to depreciate against the pound 10%. Sir, how to incorporate this? Beta, now you will be applying the interest rate parity. Clear? Now you will be applying the interest rate parity. Wait, you'll get time. Okay. A similar risk UK-based project will expect to generate a minimum return of 20% per annum before tax. Now the question is not giving you what is the required rate of return for the Butler company. It says those companies who invest in similar projects generally fetch 20% return before taxes. You need to evaluate the cash flows in pounds and Australian dollar and comment. Now this comment is little technical, that will be started. Clear? Okay, so if the question is clear, at least for the timing, we can start doing that. Okay, for the timing it is clear. They have cash inflows. It's a net cash inflow. So all the workings has been done from here. Okay, so net cash inflow generated from project is this before tax. Okay, this is before tax. Okay, so tax is supposed to be incorporated, right? So PBT. Okay, so We can start this question. No doubts. Should I refresh the panel? Okay, no questions. Okay, question number 6. Number 1, the profit before tax is given to you as 13. Okay, so less tax at the rate of 50%, which will be 6.50. 6.50 becomes profit after tax. Okay, then you will add back the tax saving of the depreciation. I hope everybody remember this step. If you ever had a longer time after clearing your CA inter, okay, I mean it has been a long time that you cleared your CA inter, or you don't remember, you are humbly requested to go through at least the IPCC or CA inter books, where you will be recapitulating, okay, as to what you had done it in your CA inter. Okay, otherwise the exams might become difficult for you to understand this. Why I'm just adding only the tax benefit, because generally we reduce depreciation from there. You're getting a point. So generally, before we reach to this profit before tax, a depreciation must have already deducted. Okay, deduct ho chuki hogi. So now, since we are taking the impact of only depreciation, we are taking the tax impact. Okay, so for calculating the tax impact, we know that it is 50% is the tax rate, but before that, we know how much should be the depreciation. So depreciation, how can we calculate? We can calculate the depreciation with this. Okay, so it says straight line depreciation is there, scrap value is 0. So this is a capex, this is a working capital, you will get it back. This is the only capex. So your depreciation is 10 lakhs minus 0 scrap value divided by 4. So that comes to be 2.5 lakhs. Is the depreciation clear, guys? Okay, so since we deduct the depreciation in all those to after contribution and all those things to get the PBT, here we are putting it over here. Okay, can we do that? 2.5 and taking the tax impact over here. So depreciation will be your 2.5 lakhs into 50%. Okay, so you will take this as, I think, 1.25, right? Looks simple. So now this is your cash flow after tax. So 7.75. Okay, guys. Yes. So cash flow after tax in the in the Australian dollar has been calculated. Now, what should be the second step? Okay. Now we know the discount rate which is there. Okay. Let's come back to the question. Okay. So now the discount rate we don't know in Australia. Okay. The discount rate for this thing is given. I hope everybody is attentive. Sairam, Akash, Harshit, dhyan se beta. In this question, beta, you are given, although which is the required rate of return is 20% in UK and we require the required return in Australian dollars. Okay, clear? Yes, sir. Previously, what did you use? Sir, we used the inflation rates. Yes or no? Yes, sir. Is the inflation rates given to you? No, sir. What is it given to you? Sir, they have given us the forward rate and spot rate. Sir, spot rate we can see. Sir, where is the forward rate? But a forward rate is given to you, it is expected to depreciate against the UK pound. So means SR becomes 2 and FR becomes 2.2. Sir, how? Better 2 into 1.10. So 2.2 becomes your FR. Is it clear or not? Yes, sir. Discount rate we calculated in the previous example with the help of inflation rates. In this question, the inflation is not given. So you can't fight with the examiner if you give me the inflation, then only I'll be able to calculate. The examiner says, I've already taught you the concept of IRP in Forex. Why you did not apply that? So in Forex, the IRP says FR by SR is equals to 1 plus interest rate divided by the another interest. So you can use that same interest rate parity in this also to get your required rate of return in the Australian dollars. Is it clear or not? Yes, sir. So should we do it? Yes, sir. Okay. So first, just tell me this 1 pound is equals to Australian dollars 2, right? Yes, sir. So if you are calculating for Australian dollars, what should come in the numerator? Which interest rate? Australia or the UK? Think about it. I'm taking you to the whiteboard. For Australia. Okay. So we have spot rate 1 pound is equals to Australian dollar 2. Sorry. Okay. And forward rate okay 10% depreciation against the US. Read that question carefully. In the exam, they can give you some other way out as well. It could become 1.80 as well. So don't do that mistake in the exam. Okay, done? Okay. Calculation. Achha, this I've already written. ऊपर ही लिख दिया. So now using FR by SR is equals to 1 plus discount rate. Sir, there it used to be an interest rate. Yeah, same thing. Okay. Okay, sir. So now, sir, what should I put it here in exam? Sir, Australia or UK? This is a big problem. I say no, it's not a problem. What is this FR? Sir, this is Australian dollar. And this, sir, Australian dollar. So Australia will come in the clear, everyone? Already taught you in the last class. Okay, I've already taught you in the last Forex class. Okay, so FR is equals to spot rate into 1 plus your discount rate of Australia divided by 1 plus discount rate for UK. Okay, and FR is 2.2, SR is 2, 1.0 discount rate that is required. Okay, sorry, that is required. So into 1 plus discount rate divided by 1.20. Okay, this is already given. Okay, this is given. So what will be the discount rate? So beta 2.2 cross multiply 1.2 divide by 2. Okay, so 1.32. 32, or we can say 32%. Clear, guys? Very good, Naveen. Very good. Nice answers. Absolutely correct. So brilliant you guys are. And do you know, a lot of people are so confused. Even sitting in the examination hall, they don't find it understandable that what should be in the numerator, what should be in the denominator. That's the problem. That's the case. Then. Okay, beta, clear? So can we incorporate this to get our answer? Okay. So now we got discount rates for both of them. Okay. How do we proceed this question? I will tell you. So I hope you have written all these things. So you'll be discounting these Australian dollars, this thing 7.75 in the Australian rate, and accordingly you will also be discounting pound, and you'll make the comparison of both the NPVs just like the way we did it in my example. Okay, clear? Chalo. Calculation of NPV in Australian dollars. Okay, simple. Now I'll not take much time. 1, 2, 3, 4. Cash flows 7.75. We have already calculated. Now I'm doing vertically. Otherwise, I was doing horizontally up till now. Okay, discount rate at the rate of 32%. Okay. $757. Okay. So what will be the NPV beta? Cash flows. So 7.75 divide by 0.757 memory divided by 0.574 memory, 7.75 divided by 0.434 memory, and 7.75 divided by 0.329 memory. Okay, so I am getting as 65.15. Okay, sorry, I forgot one thing. Okay, wait, 65.15. I forgot one thing, that the working capital will also be recovered in the fourth year. Do you remember? Just wait. See this pattern. The investments for 10 lakhs, 5 lakh of working years, which will be recovered at the end of the 4 years. So 4 we have already taken. Okay, and fourth year you will get the recovery of the this thing, working capital, which is for I think $5 lakh. Okay, so should we take you over there? Okay, fourth year meaning you will get 5 as working capital recovery. So 0.329. So 5 divided by 0.329. Okay, so total is coming out to be, no, kuch garbad kiya. Oh God, I divided it. I should have multiplied. Sorry. Divide, already have done it. My focus was main on the concept, so I just forgot. Okay, sorry, you have to multiply 7.75 because divide to we've already done, na? 1 divided by 1.32. So this is the figure that we have got after dividing it. Okay, so into 0.75 7 memory 7.75 into 0.574 memory 7.75 into 0.434 memory 7.75 into 0.329 memory 5 into 0.329 memory. Okay, yeah, now I'm getting it. Okay, 17.8735. Okay, and you will reduce the cash outflow of 15 lakhs. Okay, so now it is coming as positive 2.875. Okay, clear? But this is the NPV in Australian dollars. Okay, if you want, we can calculate the NPV for that also here only. Why to disconnect that? Okay, let me try it over here. Okay, not bad. Okay, so you can calculate the exchange rate. But this is the calculation of NPV in the pounds. Sir, why are you doing this? Beta, I will explain you in 5 minutes. Just be patient. Okay. Exchange rate is there. So cash flow after tax. Okay. Discount. It was 32%. You remember it? Iska tha 20%. Okay. So you will get discounted cash flows. Okay. Clear? So exchange rate will be, first one was easy, 2.2. We've already done 10%. We added. Okay. Then we add another 2.20 into 1.10 and 2.20 into 1.10 ka square, 2.20 into 1.10 ka cube, and I think that will be same. Okay, so that comes out to be 7.75 divided by this. Okay, because now the base currency is not the same as it was the another one. Okay, so this will be cash flow after 3.52. Okay, 2.2 into 1.1, so it becomes 2.42. So 7.75 divided by 2.42. So this becomes 3.20. Okay, so 2.2 into 1.1 into 1.1. So 2662. Okay. Third one, so 2.91. Fourth one, 2.2 into 1.1 into 1.1 into 1.1. Okay, 2.93. Let's take it 2.93. Simple. Okay, and 2.93 will be same. So this will multiply by divide by 7.75 divided by 2. Now why I'm dividing? Clear now? Forex first class base currency concept. Okay, so this becomes 2.645 and this becomes 5 divided by 2.93, so that becomes 1.706. Clear, beta? Now you can do the discounting at the rate of 20%. 1 divided by 1.2. Okay, so 0.833 into 3.52. Let me calculate पहले से ही memory plus. ठीक है ना? 1 divided by 1.2. 0.694 into 3.2 memory. Okay. So 578 into 2.91 memory. 1 divided by 1.2. 0.483. Okay, and 0.48 3 into 1.706. 8.948 something. Okay. So 483. So this total comes to be 8.948. Okay. Is it visible? 8.948. Okay. Clear? Less cash outflow, but that was beta in Australian dollars. What about in pounds? You would say 15 spent in Australian dollars means divide by 2 spent in pound. Half of them is spent in pound, because 1 pound is equals to twice as much as dollars. Okay, so opposite becomes, means you have spent half of that, yani ki 7.50. So this will come out to be minus 7.5. This will be 1.448. Okay, so 1.448. Okay, so this is the NPV in pounds and this is the NPV in Australian dollars. So shall we see what will be the NPV in pounds? 2.875 divided by 2. Almost same, 1.43. Okay, 1.4. So both of them are very much similar, isn't true? Okay, 437. Okay, so I will conclude here. Okay, so since the NPV are almost same, the interest rate parity holds true. Is it clear, beta? Thank you, Sairam. Thank you so much. Okay, clear, students? Not a problem. Okay, so till now we have spent almost 1.5 hours. Okay, almost 95 minutes we have spent. Okay, so make it round of 100 minutes. So in the last 100 minutes, what we have studied, that the concept of international financial management is nothing but the concepts of CA Inter, where we were using the NP. Simply, first of all. Secondly, the conversion of them may be required if we are doing the home currency approach. And conversion will not be required if you are doing the foreign currency approach. Number one. You may be required the required discount rate, because earlier you were calculating the discount rate only for the country in which you are doing the project. Now the discount rate of that country might not be same as the discount rate of for the another country. So you are using directly an interpolation, unitary method, whatever you want to say. You can use that with the help of the inflation rates. And in both the cases, home currency as well as the foreign currency, the NPV remains same. Same means approximately same. We had 332,200 in home currency, 332,075 in the foreign currency. So it will remain same, almost very similar. Here also you can see that we have calculated the discount rate for one country was given. We have calculated for the other country. But here we have not used the concept of inflation. We have used the concept of interest rates. Okay, the discount rates, the IRP, using the forward rate and the spot. Okay, clear? And with that help, we have seen that the NPV are almost the same as we have done that. It means the interest rate parity holds true in this. Okay, Ji, is it clear? Okay. So that ends our question number 2 as well. Okay, so our next question has to be question number 3. Okay. So at least what we can do is we can read this question for the time being, and we can do that after break or sometime, not a problem. But still, at least we can read this question. Okay. or if the time will allow, we can solve that also. That's not a problem. A USA based company is planning to set up a software development unit in India. Okay, software development unit in India. So now the country is in USA. Okay, and you want to make a setup in India. Okay, software developed at Indian unit will be bought by the US parent at a transfer price of 10 million. So whatever the software will be developed by the Indians, it will be purchased by the US company in 10 million US dollars. The unit will remain in existence for about only 1 year. Okay, so they are making investment only for 1 year only, and they are expected to get developed within this time frame. Okay, the US based company will be subject to corporate tax at the rate of 30% per annum, with a withholding tax of 10%. Sir, what is a withholding tax? But a withholding tax means like a TDS. Okay, that's the case. And will not be eligible for the tax credit in the US. Okay, so it's like a cost for them. So almost we can say 40% is tax, right? Here, the software developed will be sold in the US market for US dollars 12 million. Okay, so they are buying at 10 million, selling in the market at 12 million. Okay, you are getting the point. So it is very straightforward question. Okay, so let me tell you what it's saying. The company in US, okay, they have already a seller for 12 million. Okay, they will, this is India, they will buy from India at the price of 10 million and sell it 12 million. Now they have to see that whether in India they are able to produce it below 10 millions or not. If the cost becomes, let's say, 14 million, so why would they buy it? They will reject that. They will suffer a loss. So they have to see that whether it is prepared within the price frame of 10 millions or clear. So for that, it is telling you that if it is carried out in India, you will have to pay a rent for a fully furnished unit, which is this much. There will be a manpower cost of this much. There will be 80 professionals will be working for this number of hours. This will be administrative cost, and advise US company on the financial viability of the project, whether they should do it or not. The rupee dollar rate is 48 per dollars, and $1 is equals to 48 rupees. Assume 365 days they will be working each day. So no chutti, no holiday for the Indians. In this case, they are also like CA students who doesn't get any holiday. So for them, there is no Sunday, no Monday. They don't even know, acha, today is Sunday. Oh, my father is at home today. Why, father? You are at home? Oh, today is Sunday. Okay, I don't know. Today is Sunday. Since I've been studying every day, I don't even know what's a Saturday, what's a Sunday. Then good then. We can go out in the evening, right? For a change. Okay, any doubts? Yes, Iram. Sir, how calculated CFAT after taxes? Okay. I think you're asking for the previous question, right, Saira? Okay. We can you can start solving it. Let me just solve Sairam's query. Is it there? Oh, thank God, it's still there. But this I've calculated, okay, by this 7.75 divided by 2.2. Okay, this is the cash flow in US dollars. This is the exchange rate as Australian dollars per pound. So if the since the base currency is not same, this is Australian dollar, this is pound. So I have divided this. Okay, so 3.52 is calculated as 7.75 divided by 2.2. 3.2 has been calculated with the help of 7.75 divided by 2.42, 7.75 divided by 2.66, 7.75 divided by 2.93. and so. Is it clear, Saira? Okay, I hope that's clear. So can we start solving question number third of the assignment, and we can see that whether it is um, profitable to do it or not. It's an easy question. We can do it in 10 minutes, and then at 9 o'clock we can go for break. Okay, is it clear? Sairam, is it fine, beta? Can I rub this entire whiteboard if it is clear to you? So, solution number 3. Okay, so first is that this is a company in US. They will be selling to another company for 12 millions. Okay, they want to set up this software from India, and they will pay them 10 millions. Now we have to see what is the, price of that. Okay, price is what will be the total cost. In India, number one, and compare in dollars. Since all these transactions are happening in dollars, you will calculate the cost in India and compare with, what is the cost in dollars, whether it is profitable or not, after incorporating all the taxes and all. Okay, na? Chalo. Let's first calculate the profit. Okay, then we can do the other thing. So, what is the sales price, beta? They are getting at 10 million. Okay, and the rate is given to you as 48. So 48. Yeah, it's fine. Okay, reduced by rent. Okay, how much was the rent? 15 lakh is the amount of rent that they are supposed to pay. Manpower cost is 400 into 80 into 10 into 365. Okay, this will take is 400 into 80 into 10 into 365. Okay, 80 professionals, 10 hours each, and hourly rate is given to you. Okay, administrative cost is 12 lakh. Okay, so you can get your profit out there. So I'm putting it as 80 into 10 into 400 per hour into 365. 800 into 400 into 365. Okay, beta? Thank you, Sairam. Okay, and admin cost 12 lakh. So the profit that we get is this plus 15 lakh minus 48. Okay, huge profit, huh? 3605 5 zeros. 1, 2. Okay, minus tax at the rate of 30%. 52350. Okay, and less withholding tax. Okay, So they will have a good amount of saving in this, good amount of saving. You can see that. Okay. How come? What is their total cost? Okay. How come? I tell you. Wait. Yeah. Okay. What is the cost of software in India? Cost of software in India. Okay. So they have their 15 lakh, 11 lakh, sorry, this 1 crore, 16 lakh, 80 and 12 lakh. And these are the two taxes, tax number 1 and tax number 2. Okay. So their total cost becomes so this one and this one. So they have 15 lakhs plus 11, 68 plus 12 lakh plus tax is coming out to be iska 30% na. So iska tax is coming out to be 10815 1 2 3 4. Okay, and withholding tax will be 252350000. Okay, 000. Yes. Okay, so we can add all the one which is in green. Let me just diagram that. Just 1 minute. This one, and this one. These are all the costs. Okay, so total costs comes out to be 10815 plus 25235. Okay, so this is coming out to be total cost comes out to be beta 252885000. Sir, why are we doing this? I'll tell you in 2 minutes why I'm. Okay, sir. And this whole divided by 48, the dollar rate. So the price will come in dollars. That's the logic of doing that. Okay, divided by 48. So their costing becomes 5.2684 millions. Okay, Ji, is it clear? So they are getting at a cost of only 5 millions from US. They are getting the cost of making from the India only at 5.28. Okay, they will sell it at 10. They will give 10 millions for that, and they will sell it at the 12 million. So can you calculate the profit in the US? Can you calculate that? This is their total cost in India. Okay, 5.268. So the tax paid here, will they get any credit for that or not? We have to tell in the perspective of the US company data. Okay. Yeah. So advise the US company financial review of the project. Dollar rate we have taken. This is taken. Okay. And it says the tax paid in India, this 30%, 10% is not eligible for the tax credit in the US. So it means US will have to pay tax again. Okay. How much has they stated? No, they have not stated. Not a problem. Not a problem. Okay. Clear? So can we say what is the profit in the US? Can we calculate that? Yes, sir. So I hope you have written all these figures. You'll be requiring all these figures, right? You'll be requiring all those figures. So can you calculate that? Profit in the US, they will be selling to a third party for $12 million. Okay. And they will also be paying some tax. Okay, tax. Let's take an example that they will be paying only on the profit element. Okay, okay, okay. Let's not assume any tax. Why do assume? Let's forget. Cost of making the software in India. Okay, so this is 5.268 millions. Okay, so their profit will be 12 minus 5.268. So they will be getting 6.732. I'll write subject to taxes. Okay, subject to taxes in US. Okay, so since the project sorry, not profit, since the project in India will be profitable for the US company. Okay, so they should accept the project. Clear or not? Okay, I've not taken the impact of tax because the taxes rate was not given. I mean, the taxes which are applicable in India, 30 and 10% are there. But what is the tax rate in US? That I don't know. They will be required to pay because they say there will be no tax credit available to them. Okay, so that is the sense. Is it clear, guys? There's one doubt from our very sincere student. It says, sir, cost to US company is in dollars is 5.2638 millions. Yes, but we are buying it at 10 millions. Why? No. Wait. He's a very brilliant student. He doesn't have any problem, but let me just repeat it once again. Not a problem, honestly. Okay. Now, beta, don't think that what we are buying. Okay. This is a US company. Okay, Akash, you are a chartered accountant here. Okay, so Teju Akash is a CA here in USA. Okay, they are buying from them at 10 millions. Okay, so this is India. Their cost is 5.268. Okay, so banane ki cost, the cost of making it is 5.268. We are paying them 10 millions. So it is India's profit. But at the end of the day, when you console this, okay, when you console this, it is your profit or not? You're getting? It is just a transfer pricing, it says. Okay, just see the question, beta. Just see the question. Okay. A US-based company is trying to set up a software development unit in India, their own unit. Okay, that's a subsidiary. So when it is made in India, the cost will be 5 millions approximately, and they will pay them 10 millions as a transfer price. But at the end of the day, it's their own profit. So when they console, that profit of 5.268 minus 10 will come to their own balance sheet. The actual profit made by them is 12 millions to the outside customer minus 5.68, subject to their own taxes. You are getting my point, beta. Please let me know, beta Kash, if that is clear. Okay. So ultimately, their profit is, this is sales to outsider. This is a sales to the outsider, 12 millions. Okay. And the cost of making software in India is 5.68. So ultimately, this is their profit total. And if you want, you say profit from India. Okay, if you want, I can say as sales, or why should I say sales? It should be a transfer price. Okay, transfer price of 10 millions minus cost, which is 5.268, and that is their profit from India. Okay, 10 minus 5.268, 4.73. Okay, 2 millions are added because it is further sold at a 12 million price. I hope that's clear now. I hope so. Is it so? Done? So should I take you to the now next question, beta? Is it clear? Sure. So let's solve this. Okay, sir, I overlooked that. Not a problem. So I told you it's their own unit. Okay, it's their own unit. Chalo. So now, question number 4. Yeah. XY Limited is engaged in the large retail business in India, because that is what I was saying, Akash, to a lot of students, that this is the benefit of having a live class. A lot of students think that they can see a recorded one, but there are problems that you can't clarify your doubts. But again, up to their convenience, IC is providing them all the facility they can get. Okay, so now again a very easy question, not very tough, to be very honest. Okay, XY is engaged in the large retail business and is contemplating for an expansion into the country of Africa by acquiring a group of stores having same line of operation that of India. Okay. Now, Akash is a chartered accountant in India. Now they are setting up a company in Africa. Okay. So there the currency is called as rands. Okay, rands. So this is clear. Okay, let's go down. The exchange rate, the exchange of the currency of the proposed foreign currency country is extremely volatile. The rate of inflation is presently 40% in an year. Kahan pe? In Africa. And inflation in India is currently 10% an year. Okay. The management of XY Limited expect these rates likely to continue in the foreseeable future. Okay. Estimated project cash flows in real terms, sir. Now, what is this real terms? I'll tell you. Okay. You remember what CA Ashish, sir, the deputy director in Board of Studies, said in the last class? That beta, if you do Forex properly, you will also be using certain concepts in your international financial management of this real terms, nominal terms, and inflation. Okay. How to use them? How to remember that? I will give you a very simple, funny remembrance. I think I've shared with you in this class. I think so. I'm not sure, but still I'll tell you. Okay. As well as in the African. Okay. For the first 3 years are as follows. So you can see it clearly that currently in India they are incurring losses. They are incurring losses. But in Africa, they are expecting to have a positive cash flows in the next 3 years. So XY Limited assumes, okay, just 1 second. Yeah. So XY assumes 3-year nominal cash flows will continue to be earned each year indefinitely. Okay. It evaluates all investments using nominal cash flows and a nominal discount rate. The present exchange rate is African Rand 6 to rupees 1. Okay. So this is a direct quote. You can convert into an indirect quote. So 1 rupee is equals to African Rands 6. Okay. You are required to calculate the NPV of the proposed investment considering the following: that African Rands cash flows are converted into rupees. So now tell me, is it a home currency concept or is it a foreign currency concept? Can anybody tell me? Look at the first requirement, beta. African Rands cash flows are converted into rupees and discounted at the risk adjusted discount rate. Now tell me, home currency approach or is it a foreign currency approach? Please tell me. Let's see who knows the example which we started in the starting. Okay, who remembers it? Let's see. So I'm saying as per requirement number 1, what is it? Is it a home currency approach or is it a foreign currency? That you need to tell me over here. Okay. Second is all cash flows of these projects will be discounted at the rate of 20% to reflect its high risk. Ignore the taxation. Okay, ignore the taxation. Is it clear, guys? No doubts? So shall we start? Okay. So first of all, I must tell you what Ashish sir said theoretically, because he was on the screen, he was not carrying a pen there that time. So what sir said, let me explain you. Sir wanted to say that there are cash flows which are given to you in the real terms cash flows. So real term cash flows means you have not incorporated the impact of the inflation out there. Getting my point? Inflation means what is the impact of DNS in the country. So when you incorporate the inflation in the real terms, what you get is the nominal rates of cash flows. Clear? Teju is the first one to give the correct answer for this one, and there is no doubt on his brilliancy that he is absolutely correct. Very good. Okay, beta. So this is what sir said in the last class. So to get nominal, you need to what you need to do is you have to multiply real into inflation. Sir, how do we remember in the class? See, after other countries have opened a door, sir, everybody wants to become a NRI, non-reliable Indian. Oh, sorry, I mean non-resident Indian. Okay, non-resident Indian. This is what you have studied in your income tax. So don't worry, I'm not teaching you income tax. Other teachers are better than me in teaching. So I want to say you can use this NRI, that N is equals to R into I. So in exams, you have to check that whether the cash flow which is given to you in the real terms or it is in the nominal terms. Okay. If it is given the nominal term, then it's fine. No conversion is required. But if it is given in the real term, then please convert them into the normal terms by multiplying with the inflation. Clear? This is what sir wanted to tell you in the last class, but since he said it on the screen, I have explained it to you by with the help of the question. So if he is hinting that this is important, you should be knowing because he has a decades of experience in formulating these study material. Okay, beta, chalo, let's go quickly. Okay, so what I'm supposed to do is we can see the first thing is that the main thing is first the conversion of the real terms into the nominal terms. So how can we do that? Let's calculate the impact first. Okay, so should I take you to the screen? Any doubts? No doubts? Okay. Okay. I'm removing all this, huh, beta? Now this is solution number, I think 4, huh? 4. So just to give you a recap, what we have done, we have started our class with the two approaches, home currency and foreign currency. So Teju has given the correct answer that what we are doing right now is the concept of the home currency. Okay, in this question. Then we did question number 1 of the assignment, followed by question number 6 of the assignment, question number 3 of the assignment, and now question number 4 of the assignment. So we have covered a lot of part today, okay, and very important one as well. So first of all, we have to calculate the calculation of inflation adjusted cash flows. Okay, so year 1, 2, 3. Okay, what is the real cash flows? $1,500, 2,000, and 25. Can everybody see? Hello, 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 hello. Okay, sure. 15, 2,000, 2,500. So 1,500 negative में, हाँ, 2,000 negative में and 2,500 in negative. How to calculate the inflation factor, beta? It is given 40% over there and 10% in India. Okay, so at the rate of 10% here. Okay, so it will be 1.1 because base is for the first year it is 10%. Then for the first year becomes 1.1. Okay, 1.1 ka square and 1.10 ka cube. Okay, so you will get the impact over here. Okay, what will be the nominal cash flows? ये याद रहेगा ना? Will you able to remember it, beta? Okay, first one is simple, right? 1.1. 1650. Say 2000 into 1.1 into 1.1. Okay, clear? 2420. Three three two eight. Let me put it not in decimal. Okay, clear, beta? Done. No doubts in this. हाथ के हाथ लगे हाथ. I mean, in English means let's do it simultaneously for. This is for India. Okay, this is for India. Let's do it for that as well. African rands. Okay, both AR and rupees. So do you remember the cash flows? If I don't remember, how would you remember, right? Okay, 20, 70, and 90. Okay, maybe let's complete this. There will be no inflation effect on the P0 because for the current year, we know we have already taken the impact over there. Okay, so this is 20, 50, 70, and 90. But these are all positive ones. Okay, inflation at the rate 40%. Given you in the first line, you can check the assignment. 1.40, 1.40 ka square ka cube. Okay, so you will get nominal cash flows. Okay, 50 into 1.4, 70,000. 1.4 into 1.4 into 70. 137,200. No doubts. Hi Talwari Venkatesh, right? You're sending me hi, huh? Hi. Is it not clear something? 1.4 into 1.4 into 1.4 into 9,000. Okay, so 246, 960. Clear, beta? So now the first thing has been done. What Ashish sir was telling us when he came up. Now we'll be doing some other calculation which will be required for this purpose. Okay, what is the another challenge that a person gets while doing the home currency? He needs a discount rate. Okay, number one. Second is the major important thing is the conversion rate. Okay, that is the most important. So first thing we have done, you can write it in your notebooks what I'm writing. Okay, steps for home currency. Okay, you remember the steps? Number one, we need the most importantly as the discount rate. Okay, the discount rate. Just observe it in the exam whether this is given or not. Number two, cash flows. Okay, in the nominal. Okay, and cash outflow again will be simple. And third is the calculation of the NPV as a whole, because we have to incorporate both of them as per this question which is there. Okay, now what we need in this is that what will be the forward rate. Okay, so better, since we have the inflations with us, we have inflation 10% over here, 40% over here, can't we get the forward rates? Yes, sir. Okay, forward rates for why? Because these cash flows needs to be converted according to the currency. Clear? Yes. Achha. If that is clear, tell me, can you use the purchase power parity here? Can we use the purchase power parity here? Interest rate parity is with the interest rates. Purchase power parity is with the inflation rates. Yes or no? Okay. So we'll be using purchase power parity to get the forward rate. Should I come back again? Yes, sir. Achha, tell me one thing. Bataiye, sir. We started with our class 7-5. Yes, sir. I'm not confirming you, I'm just telling you. What is the first thing that we did? Remember, 50,000 was cash outflow, 25, 20, and 15 were the cash inflows. Sir, you remember that? I'm teaching this concept for so many years, so I also ratify the things. Okay. The first thing we did was we calculated the exchange rate using the PPP. So 70 rupees with the impacts of the inflations. We calculated the rate, something came as, I think, 65 something, then 50 something, aise kuch. Okay? So this is what we are doing here also. The only difference is that there, I did not tell you that the cash inflows are nominal or real. You assume them to be nominal because in CA Inter, you never did such kind of a concept. In this, the very step, if you have made the notes, or if you want to go back to the video again at 7:05 or 7:10 p.m. AM pay, you will see I calculate the exchange rate using the purchase power parity, which is the forward rates. Okay, forward rates will be incorporated with the cash flows which are coming in the next 2-3 years, and then we can see if it is doing business is good or not. NPV comes out to be positive or negative. In my example, NPV was coming out to be negative. Okay, here we have to see. Acha, sir, is there any difference between the question that you, the example that you did in the starting and the question is this? Yes, there's a big difference. Sir, what? There, we were making an investment outside India. There was no investment from within India. Sir, come back again. You were only investing $50,000 in the US, right? Yes. Was there any cash flow from India? No, sir. So we took only one cash outflow. In this, we have although one cash outflow, okay, but we have cash inflow from two countries. One is India and one is Africa. We have to add them. Getting my point? Sir, but cash flow from India is in negative. So what? It could be positive. It could be possible that cash flow from Africa substantiate the losses from there. So you're getting my point. In my example, at 7:05 or 7:10 a.m. in the morning, I took only one cash outflow and only one cash inflow. In this superb question of the study material, ICA study material, we are incorporating the cash inflows from African rands, cash inflow from the India, and we see with the cash outflow, whether it is NPV is coming as positive or negative. Are you getting my point or not? Clear? Everyone done? Yes. Yes, sir. Yes, sir. Yes, sir. Oh, so many yeses. Okay. And Teju is also saying, yes, we can use the purchase power parity, not PRP, Teju, PPP. Okay. When I was in, I think nursery, I guess there was this song coming up, PPPPPR, some Pooja Bhatt song. So that wala PPP. Okay. Yeah, I was very small that time, and अभी बोलना आता ही था, तो I started used to sing this song, PPPPP wala. So that is not PRP, this is PPP. Okay, funny side, because I know CA final में studies get little tough, so just on lighter side. चलो. Now coming to the calculation of the exchange rates, right? Sir, which one should we use, the direct quote or indirect quote? Beta, you can use anyone. The answer will not change. As you know, the answer will remain same, right? Okay. So as you know that the 1 rupee is equals to 6 African rands. Okay. So you can either use in this way, okay, or you can use in some other way. That's not a problem. Clear? Okay. What is the doubt coming? Just 1 second. Okay, fine. I'm going with that. Okay, so this is the spot rate. Okay, and just to tell you, this is a direct quote. So let me take you to that further forward rates. Okay, for year 1, 2, and 3. Okay, so spot rate will be this is indirect quote, will convert into a direct quote. Direct quote is equals to 1 divided by 6. Sorry, sometimes I confuses you, so you would be thinking, sir, kya likh diya? Okay, so spot rate is for the first year, it will be 0.1667, okay, into 1.10 divided by 1.40. Clear or not, sir? Beta, ye rupees mein aa gaya. This is African rands. So we are calculating, this is for rupees. So upar wala bhi will be Indian rupee and 40% will be African. Whatever will be in the numerator denominator for the forward rates, the numerator will always be that same currencies, inflation rate or interest rate as the case. Now, so I'm sure you must be a champion for that. Clear? So can we get the first rate, beta? (1.1) divided by 1.2. 0.1309. Okay, yeah, 1310. Let's write that. Okay, clear? So 0.1310 into 1.10 divided by 1.40. Clear? Third one. (0808). Okay, or 09, whatever. Clear, beta? Yes, sir. So can we calculate can we know the cash flow rands? Okay. We calculated in the previous slide. You remember? Okay. 70. Let me just see from there. There's a mouse. Okay. So 70,000. Okay. 137,200. Okay. And it was 246,960. Here. Very clear? Sir, could there be a chance in an examination question inflation vary? I'll come to that, Akash. Very good question. Very good. I've read your question. I'll come to that for sure. Just give me a few minutes. Okay? Just give me a few minutes. बचा लोग तो हम कहाँ हैं? We are at this. Okay, African rands. So now this is clear. Now we can convert this into the cash flows by converting into there. Okay, so cash flows in INR. Okay, can we calculate that? Kaise? That is why we have calculated this thing. You can multiply that directly because this is also in rands. This is also in rands, and you can directly multiply them. 9170.1029 into 137.1029 into 13720. So 14118. Okay, 0.0808 into 246960. Okay, so this becomes 19954. Click. Okay, clear? And the cash flows, this is after conversion. This is which is given. Okay, we had calculated that in our previous workings, if you remember that. Okay. Just 1 second. Let me search. कहाँ दिया था वो? Okay, yeah. So this was given 1650. Okay, and this 2420. The very first calculation that we did in the previous one. Okay, and this. What was that? Top में था ना शायद कहीं 3328. But these are all in negative, right? You're getting a point? This we have calculated the nominal adjusted with the inflation. You can see, you can go back to the video just in case you are not writing it, you're just watching it. You can see it. Okay, this is what we have done. Okay. So these are the negative ones, these are the positive ones. So are they enough to cover up? Yes. But are they able to generate that, cover up that cash flow outflow is not, that's the most important. Okay. Till now, I have not done anything. One step is remaining. Okay. One step is remaining. I will do that before I will like to answer this very intelligent boy. Teju Akash, sir, there could be a chance in examination that inflation rate vary each year, that is not being 10% every year. Pehli baat to Akash, examiner can give you anything. Okay, and you are of such a brilliant mind that you don't need to worry. First of all, okay, let me say that the inflation is, let me take some other color, green. Okay, let me say the inflation is 40% first year, 50% second year, and 60% third year. मान लो, just in case. So क्या करना है? कुछ नहीं करना है. यहाँ you can put 40, here you can put 50, and here you can put 60. How does it matter to you? For a caliber of you such a student, should not be a problem. You just have to make the calculations change. That's it. Otherwise, what people generally do is this, for the next year, it becomes square of this, third year becomes cube for that. So that square and cube will not work. You will have to just change these numbers. I hope that's fine. Akash, okay, Teju Akash, it's fine. Chal. So this is done. Yes, sir. One thing I would like to also incorporate over here, and what is that thing? Let me show the assignment to you. Terminal value I'm looking for. Okay, terminal value. So see, one thing is that discount rate is already available with us. Okay, all these cash flows will be discounted 20% to reflect the high risk. This is in rupees. Sir, are we supposed to change this? No. Sir, why? See, beta, these African rands First, this real terms we converted into nominal. Yes or no? I repeat, this African rand, all the working is taking place in India. Okay? Answer is in India because this is a home currency approach question. You take all your cash flows over here, you convert them and see whether the NPV is positive or negative. In example number 1, there was no cash flows from India, only cash flows from outside subsidiary. Here there are cash flows from India as well. So you are adding both of them. Yes or no? Yes, sir. So the first thing was we converted this real into nominal, and then further it was incorporated rands to INR. This got converted. This African rand become INR, and we added both of them. Yes, till now we have done it till here. One thing I would like to incorporate is that the impact of the terminal value. Okay, there is a terminal value which will be there because it says XY assume 3-year nominal cash flows is continue to be earned each year indefinitely. Okay, indefinitely it will be earned. So clear? So how can you incorporate that? The last year's, third year's terminal value you can calculate. Okay, 3 something. Okay, so this is clear or not? This is clear? Yes or no? This line. This line. Okay, this you have to see. Sure. So let me write over here with the terminal value. Okay, let me write TV because it is not getting incorporated. So 3328 divided by 20%. What is 20%? That is the discount rate. Okay, that's a discount rate. Okay, so 16640. This step is because of the line that I showed you which got vanished. Okay, I colored it and the color vanished, right? Okay, so now this is done. So can we apply the present value factor here? Yes, sir. So let's apply present value factor at the rate of 20%, which is also given to us. Okay, so beta 1 divided by 1.2 0.833. सबको clear हो रहा है? Asking possibility. Yes, there can be a possibility. And for a caliber like you don't need to worry, Akash. Okay. The examiner can give you anything out of box. So you have to be prepared for anything in the exam. 5, 7, 8 and same 5, 7, 8. Okay. You can calculate the DCF. Can you? Yes, sir. So, kaise convert a DCF? You have to add both of them. Okay. You have to add both of them and then you discount with them. Add both of them, discount with them, add both of them, discount with them. Isko to directly you have to discount. Okay. So I am getting as 9170, okay, minus 1650. So I am taking impact of 7520 into 0.83. Okay. So that becomes 624. Let's take it 2. Okay. Coming as like that. So 14118 minus 2420. So 11698 into 0.694 into 0.694. So this will be 8118. Okay, 19954 minus 3328. Okay, so that comes out to be 16626 into 0.578. $9610. Let's write that. Okay, beta, and 16640. Okay, into 578. Clear, guys? Okay. Oh, sorry, divide by 20%. 3328, 16640 and 16640 into 0.578. Okay. Any mistake have I done? Terminal value is this and divided by this. One 6640 48204. Okay, beta. So this value has been calculated. Okay. So 6242, and now I have less days, although 48204. Okay, it is coming out to be, this is terminal value. Somebody is asking, sir, what is this 48204? This is the terminal value. Okay, terminal value. So the cash flow for the third year, which is 16626, okay, divided by 20%. Okay, I think this is creating confusion for you. Okay, ऐसे कर लो. Okay, ऐसे कर लो. So 166 ये वाला. Okay, 16626, okay, into 578, because this is the that value na, forever wala. Okay, so this comes out to be total cash inflow 72. Yeah, see the, let's calculate NPV directly. Why to waste time? Okay, okay, NPV is equals to 72,174 minus cash outflow. Let's go to the cash outflow. That will be our last part for the day. So yes, beta, cash outflow is 50,000 INR and 2 lakh for the rands. Okay, so how to convert this 2 lakh into that? Okay, this can be converted as divided by 0.167. Okay, this rate is given. Okay, so 50,000 plus this 2 lakh divided by 0.167. So this comes out to be, sorry, not, sorry, divide by either 6 or either multiply by this. Okay, so 2 lakh into 0.167. So 3340. Okay. Cash outflow in rands. Okay. This is in rands. This is the base currencies per rupee. Okay, so yeah, you can do either 2 lakh divided by 6. Okay, because this is a rupee per, sorry, this is rands per rupee. This is African rands per rupee. So you have to divide. Otherwise, you can say or 2 lakh into 0.167. Okay, so this is going to 33400. If you do it like this, then some other answer would come, which is 33333. So you can take either of them. Okay, 33,330. Okay, so you can add with this. So your total cash outflow becomes 50,000 plus this is 83,330. But at any step you want me to repeat, please let me know. We have time. Okay, ऐसा नहीं है कि 10 o'clock this class gets over. You can extend it for whatever time you have. Okay, so where is that? Yeah, Okay. Okay, done. So minus this NPV is 83333. Okay, so it is coming out to be minus 72,174. Oh, it's a negative one. So 11159 is coming out to be negative NPV. So since the NPV is negative, okay. So since the NPV is negative, you since the NPV is negative, so you are rejecting this particular project. Okay, it's not worthwhile. Okay, therefore reject. Sorry, I have less space. You can understand. Okay, beta, is it clear? Any doubts? No doubts? Done. So I think sir is not there today. Maybe he's busy with some work. So beta, if that is the case, let's wait for about 30 seconds and then we can wind up today's class. Okay, any doubts? So here today we covered the first thing. First part means first thing. Let me just show you. Yeah, this one. So we have covered the first concept today. Although again, I'm not saying that this is over. We have few more questions over there. You can see the assignment. Out of 8 questions, we have done question number 1, question number 3 and 4. We are left with 5, 6, 7, 8. And once we'll do international source of finance, then we will do question number 2 in the last. Okay. So I hope till that time you will stay safe and take all the precautions. Okay. As far as the virus is concerned, just take care of yourself. We will see you next day after tomorrow, that is Friday, to conclude this time. Okay, thank you so much, Teju, Akash, Sairam, Harshad, Naveen, Prakash, for your very sound support, and hope to see you soon, day after tomorrow. Okay, take care. Thank you, Bodo Studies. Thank you, ID team, for this glitch-free performance.